Welcome to Private Lending Insights. I'm your host, Rocky Butani. This episode is mainly for private lenders or private lending companies. I interviewed Kevin Kim, who is an expert in private mortgage fund formation, or also known as debt funds or mortgage REITs. Kevin Kim is an attorney with Jurasi Law Firm based in Southern California. He has formed a ton of mortgage funds over the years. He's an expert in this matter, and I think you learn a lot from this episode. We talked about what he's seeing in the market, what are some of the trends he's seeing with new fund formation, with the secondary market, with raising capital, and dealing with banks as well for additional leverage. So I hope you enjoy this episode. Let's get started. All right, Kevin, thanks for joining me for Private Lending Insights. Tell me what's happening in your world. How's everything going? And the world of debt fund mortgage REIT formation.
Right. Well, first of all, thanks for having us. Thanks for having me as well. This is weird being on someone else's podcast for once. Yeah, I mean, it's a very interesting time. 2024 was a very interesting year on that side of the house. The activity was pretty flat. It wasn't greater in volume than 23. REIT formation was down significantly until the end of the year, and I think the reasoning was because of the uncertainty of the election, which would lead to an extension of the Tax Cut and Jobs Act. I think the assumption was if the Republicans win, they're going to extend the tax cuts, which would make REITs viable for another, who knows, 5, 7, 8 years. And so a lot of lenders were contemplating a fund, and they were kind of holding off on the REIT, right? Which just makes sense, right? It's not that 20% pass-through savings is vital to that decision-making process. Another phenomenon we saw last year and continuing to see this year is that the vast majority are folks that are either capital constraint on the balance sheet because of their loan sales are a primary driver of the business. They're finding themselves having a lot of loans that can't go to sale, right? And so the other kind of common use case for the debt fund strategy were lenders that knew that they had no market for those loans. And so, commercial bridge lenders, obviously, a lot of the more esoteric residential lenders, legacy hard money lenders, and even the folks in certain markets that there really isn't a secondary market for those loans, right? We thought there would be an uptick in distressed debt strategies. We didn't see it. So we saw a good amount of opportunistic, but not a big uptick in NPL or RPL strategies as a fund concept. One big thing that we did see and we continue to see is a continued, I guess you can call it, attraction to raise money overseas. So last year and the year before, we did more overseas work than we've done before, and it continues to be the case. And it makes sense. I mean, the overseas markets are much more beaten up than the U.S. market, and so there seems to be a lot of attraction for non-U.S. investors coming into the U.S., and so that requires a little more complex thinking and structure. But that's kind of the state of the market. Things are relatively kind of flat. It looks like formations are up a little bit going into Q1, and I think what's interesting is that there's a lot of interest now from high net worth investors and family offices now that the election is over, right? And they're feeling a little more bullish, feeling a little more confident to deploy capital. So,
And what is it exactly that they're concerned about? Is that the QBI deduction?
I think that's one factor, but not the only factor, because the 20% tax deduction only applies to your investment in the REIT, right? So it is one factor. I think overall uncertainty, right? So, are we getting into a more business friendly environment, deregulation? Are we looking into the next 4 years? Are we looking at something that's going to be meaningfully beneficial for an investor as opposed to the mortgage market is going to suffer? We're still seeing a lot of complaints, like investors, sponsors come back and say, our investors are complaining about this. How do you address it, right? And that's usually like kind of equating the local market woes to the national market. And so like this is a common thread we heard last year, especially for lenders in Texas, particularly in the kind of the Austin market. It's like, oh, Austin's having its headwinds. isn't the entire mortgage market like that, or entire real estate market like that? And the answer couldn't be further from the truth, right? So that's what was the concern. But now it seems to be the sentiment is a lot more bullish. And hey, look, things are looking up. There's more opportunity coming our way. Tax laws are going to be more beneficial. I think the sentiment is that the current administration is much more business friendly, which is probably why investors are starting to kind of open their ears up a little more. But sponsors are also opening their ears up a little more, and so they're finally executing on things they've been talking about for 6, 8, 10, 12 months. So.
Interesting. Private lending in general does well. It performs well through all sorts of markets. There's always a need for it. So I'm a little surprised that I guess I never thought about how an investor in a fund would think that the market is uncertain. Or the mortgage market is uncertain. So
they don't know that though, right? So that you're thinking about a relatively uneducated investor that thinks that this industry is correlated to the broader mortgage market, and so they kind of correlate. Oh yeah, well conventional mortgage is not doing so well. You must not be doing well. But no, nothing could be further from the truth. We're such a small market, compared to the broader mortgage market, and so it's very hard for an investor who's high net worth investor, family office investor, even the kind of like the more quasi-institutional, I will call not insurance, but like endowments and charities. They don't really get it either, and so that was been the objection. And I think that's getting better, right, over time. But it's still we're still waiting to see kind of the fruits of this new administration. So it's not. I'll call it this rush to the door. The rush to the door, the increase in volume, I think, is more akin to you have new market entries across the country because it's an attractive market, and you have a larger subset of loans that don't fit the secondary market, or they don't qualify to work with the secondary market, and that's causing an increase in interest in balance sheet strategies.
But for the lenders that don't look for the secondary market, they don't care about the secondary market, they just want to balance sheet all of their loans. That's a pretty common fund strategy, right?
Yeah, I mean, industry wide. If you look at the whole industry as if you look at it from like a kind of 30,000-foot view, it's a weird market, right? Because I think I was talking to someone at Fortra about this. I think it was to Sean over there. He's like saying the way the concentration breaks down, if you look at all of the loans in, you can call it private lending, and if you exclude DSCR, because DSCR changes the calculus a little bit, the largest market share is really like the largest holds of the market share, total market share is only like 20%. 80% is held by the bottom 10, bottom 80%. So the top 20% is held by the top 10 lenders, right? And then the 80% is held by the rest of the country. And if you look at the broad spectrum of guys who prefer to balance sheet, it's about half, right? Half or more, because I don't necessarily know if it's lack of knowledge about the secondary market, but more common thread seems to be like lack of conformity, right? They don't want to conform to the secondary market book. They just don't. There's a lot of loans they want to do that just don't fit. And so whether it be bigger multifamily deals like commercial stuff, or it's like, the deal is just a little bit more complicated, and doesn't fit the necessary buy box, so that's, or they're not getting the service they want. I've also heard that before. They're not getting the service they want, and so they say, you know what, I'm just going to do it on my own,
Yeah, and it limits the creativity with their lending. Like, they have a tight box. It's, at some point I could see a fund manager saying, hey, this is not enjoyable. I actually want to do this loan because I think it makes sense. I like it. I don't want to be beholden to a secondary market that wouldn't see this loan the way I would see it.
And even clients who do sell to the secondary, they understand the reality of Wall Street being fickle, right? And that's okay. And so they understand that, hey, we need something to be able to put the loans that don't go there, and because it's a borrower that's going to come for both types of deals, and the borrower comes first, the service comes first, the capital solutions are their problem, right? They owe their borrower a good experience if they're going to keep them sticky. And so, of course, you're going to have multiple product offerings that can fit the solutions. So yeah, even the bigger shops are building bigger, balance sheets. And we talk about securitization all the time. The guys that are doing securitization are realizing, oh, maybe my balance sheet's not big enough. I'm not getting the better pricing that I want, right? So they're focusing on building their balance sheets too. So,
And is that the main reason why a lender that's primarily selling most of their loans to the secondary market, that they would build a debt, I mean, they would form a debt fund and raise capital just because that's required by the loan buyers, or what is the main driver of that?
I think it's a matter of preference, right? So there's kind of some external factors that lead clients down the path of choosing a fund over any other strategy. The first thing is getting leverage, right? Banks tend to prefer to see a fund strategy because it's equity-based investment. The investors are coming, the LPs are coming in as LPs or members of an LLC, so they don't have to worry about intercreditor issues with another lender, right? That's issue number one. Internal preferences is because you can do a lot more engineering with an equity-based waterfall than you can with a debt-based investment. It also, it's equity, right? So you're not over-levered if you're just all debt, right? So the conventional wisdom that you see in non-QM and conventional mortgage, where they just are debt-laden, right? Because they're borrow, fund, sell, borrow, fund, sell. That's not what we're doing here. And so a lot of clients don't want to be over-levered with either investor debt or subordinate debt plus senior financing. So an equity-based strategy is more attractive for that reason, but also because you can engineer returns in a much more creative manner, right? And you can align interests, right? When you win, they win. When they win, you win kind of arrangement, as opposed to a debt-based investment, which is I owe you 9% or 8% or whatever interest payment that you're making, right? So there's that aspect to it. And also like kind of market sentiment, right? If you look at kind of across the industry and a lot of the more independent, non-institutionally owned, successful outfits, a lot of them have a fund, right? They have a debt fund structure. So that's another good reason. There's wisdom to the historical choices of other lenders, right? So, yeah, I mean, there's a lot of good reasons to do it. Other clients have said, we want to do it because we're used to doing it on the real estate side. They come over from real estate, right? And they do it. They've been syndicating and do real estate funds and REITs in the real estate world. They translate that over to here. So that's another reason why we see a lot of this happening. But yeah, all good reasons though. Yeah.
But let's say there's a lender that's primarily, their model is, hey, I want to fund a loan and I want to sell to the secondary market. It seems like a lot of those lenders have formed a fund in the past few years. More of a trend starting from 2020,
yes,
post-COVID.
Yes.
But are they just building up their own balance sheet just so they could have a bigger balance sheet to fund more loans that they're going to sell?
Yes, that's one factor. So there's kind of, when I would say there's three factors. I just interviewed Bree at Cardinal. We discussed this at length. There's a lot of shops like this, right? So, shout out to Bree. There's a lot of these. They have a couple different reasons. So reason number one is that, right? They want to be able to sell their loans, not table fund, not broker, not correspond, because there's more economics to it. But that means that they need a larger form of cash to fund their loans to close and then sell them. So it's a combination of investor debt, investor equity, investor investments, plus lines of credit, as much balance sheet capital as they can get to temporarily fund and sell. That's issue number one. Issue number two is it's a great backup plan in 2020, right? So we saw the ups and downs during 2020 into 2021. And then in 2022, 2023, we saw a lot of downward activity because of the rate hikes. So everyone who is an active seller of loans knows that Wall Street is fickle. The aggregators are starting to understand that it's widely understood, and they should communicate that to their counterparties and get their expectations to understand. A lot of drama around that in 2020. And so that up and down nature, the fund becomes a really great backup plan, right? So if I can't sell the paper, at least I can get some loans closed and I can hold them on my balance sheet, and I don't jeopardize my borrower relationships, right? All of this centers around the borrower relationship. You don't want to jeopardize that, because if they can't get it done with you, they'll go somewhere else, right? So, and I think the third reason has more to do with the whole idea of doing loans that don't fit the box. And at AAPL this past year, November, we called them non-conforming strategies, right? Non-conforming loans. We're kind of borrowing from our friends in conventional mortgage, right? The idea is that you have the loans that go to the secondary, and those are good loans, right? And you can do those loans, and you can fund them and sell them, make a nice profit. But there's going to be loans that don't fit. They just don't, right? Whether it be 5+ multifamily, whether it be a more complicated construction deal, or something that you're going to have to get creative on the structuring, and it all distills down to the borrower relationship, right? And how much you want to keep the borrower sticky. That also is a big driving factor. I want to be able to close loans that I want to do, but that they won't let me do. And so that's also a driving factor. All of these are good reasons. If you think about what our industry is really kind of modeled after, this has been the argument, this has been the debate since the secondary market was created. Are we modeled after the residential mortgage market, the broader consumer conventional mortgage market or non-QM market, or are we modeled after the commercial real estate market on the bridge side, right, and the construction side? I would argue that we're kind of taking the best of both worlds, right, and more actually looking like commercial, because these loans actually act like commercial loans, and the borrowers are more commercially oriented as opposed to a individual homeowner, right, that's just looking for the best deal possible and is buying one home every maybe at best 3 or 5 years. So it's different, right? So in that regard, we're seeing a lot of ideas being borrowed from the commercial real estate world. So,
and with the lenders that do sell their loans to the secondary market, and they do have a fund to have a balance sheet to fund them, are you seeing any new trends as far as the secondary market goes?
Mm-hmm. Yeah. I mean, so middle of last year, we saw an increase in attention from the secondary market in multifamily, right? I mean, Turek, they did their multifamily deal last year, and a few other shops are now actively looking for multifamily, which makes sense, right? There's a lot more activity and a lot more deals happening in that sector, even in the smaller stuff, right? The challenging issue is there's a limit to how big these loans can get, right? And so, they can only really work with the small kind of, I could call them micro multifamily deals. But an advent of, kind of commercial real estate loans coming back to our sector, because, Rocky, you remember back in the day, like our guys would do commercial, our guys would do resi. It was kind of a mixed bag, right? We only saw kind of doubling down in resi probably starting in 2019, 2018. So, but yeah, I mean, that multifamily mixed use coming back as an asset strategy. I guess you can call them forward flow agreements. We're starting to see a lot more of those come to our sector, which is great. Kind of rate lock situations, which are great for the counterparty, much more predictability. And we saw a significant increase in what we're calling JVs, right? So an originator is partnering with their counterparty on the secondary market as a JV partner, as opposed to just a traditional MLPA type selling arrangement for preferable terms. And so that's been giving a lot of these people horsepower on the origination front, but they're still finding themselves like, hey, we still need a balance sheet, right? So, but that's been a very, what I've seen, it's been very, very accretive to the originator, and they've really grown significantly thanks to that relationship. I think we'll see more of that going into next year. Going into 2025, and other folks bringing in that kind of strategy, because it's a good one, I think. So
interesting. But if they have a JV partner, then they typically don't need a debt fund, right? Because the JV partner is their capital source.
Yeah, and I think that's the interesting dynamic we're finding, is that you still do, because I always tell clients this, right? Your deal flow is going to outpace your capital no matter what you do, right? The more deals you do, the more attractive you become, the more attention that you get, and your deal flow just outpaces your capital. Everyone is capital constrained, right? Very rarely do we hear people that are deal constrained. So in that respect, then the deals aren't always going to fit. They never do, right? So you need an outlet for it. And if you're 100% reliant on the secondary, you're just not going to find it. So what's your option? You want to broker it to another lender? If you're a direct lender, that's the last thing you want to do, right? In this competitive marketplace, you want to keep that borrower sticky. So the debt fund is definitely still a necessary component to those strategies.
Nice. And you said you're seeing some fund managers go outside the country to raise capital.
Oh, yeah.
Is there anything that needs to be done in order to make that possible? I figure if I'm a fund manager, I have a fund, someone from outside the country says, "Hey, I want to invest in your fund." What else is there to it?
Yeah, I mean, this additional legal considerations. It's not really like securities law issues. Relatively easy on the securities side. Regulation S, local compliance. It's primarily tax driven and also Treasury regulations on anti-money laundering and Bank Secrecy Act stuff, right? So you want to make sure that you increase your underwriting steps on your AML, KYC requirements on your investors because there's a higher likelihood of that going on and lack of visibility. So that's issue number one that you have to address. It's relatively easy today because there's so many vendors for that. And then secondarily is this tax. Tax is a big issue because the U.S. has very strict tax laws when it comes to offshore investment into real estate related strategies. There's an automatic withholding. There's this concept called active trader business treatment. There's issues associated with kind of trade regulations if you lend from overseas to your company here. So it just basically requires some additional layering and structuring. So we're typically going to get creative with the client, and lower budget clients will do something simple like an offshore loan. More sophisticated clients will do typically a feeder fund overseas, usually in Grand Cayman or in BVI. But that's usually the layering that we're doing. It's a much more complicated structure, but if the client can raise the money overseas, it's definitely worth it.
So if there's a fund manager who's just getting a lot of interest from international investors, then you think it makes more sense for them to just start a separate fund in Grand Cayman?
I would call it an affiliate fund. What we're doing is we're creating a fund overseas, and that's going to feed into our U.S. master. So it's kind of an affiliate feeder fund. But yeah, I mean, it all boils down to how much money you can raise, right? Is the juice worth the squeeze and the economics and all the costs? And I say, usually most clients are willing to get out of bed for a commitment of over $30 million up, and that's when it becomes worth it because it's, kind of expensive to do. So.
And which countries are you seeing that there's investor interest in our space?
Yeah, for a long time, South America was a very, very common call, right? Clients are saying, and Central America, right? So all Latin America was just a relative a lot of interest. I mean, Argentina was an obvious, reason, but Mexico as well, especially for our clients down in Florida. Lately, we've been seeing some interest out of Western Europe. That creates more complications because of the EU. And then there's always going to be interest coming out of kind of the Middle East as well. We see a lot of that. Dubai is always in the conversation. I mean, the funny thing is Dubai is a country where the investors aren't from there. They happen to live there now, right? That's a common thread. So, enhance your money laundering due diligence. But yeah, I mean, Dubai, UAE in general. And then also for a solid, kind of 6 to 8 months, we saw a lot of activity out of Israel, and then the war happened, so it kind of killed it. But we had a good amount of activity coming out of Israel for a long time in our industry. But that's kind of quieted down. I think once the, ceasefire is in place and everything's kind of resolved, we'll start seeing more activity coming out of Israel.
And for international investors, are you, from what you're seeing through your clients, are international investors still finding the returns attractive? Where if, let's say, they're, the lender can get them a 10% return, for example, annual, and then they have to pay taxes on that income. Is that still attractive to a lot of international investors?
Yeah, so that's why you have all these different structures in place, right? So the goal here is to mitigate the withholding, right? So we want to eliminate the withholding to the best degree possible. So if we didn't have all the structure we talked about earlier, it'd be like a 30 or 37% withholding, right? That kills your returns. So this eliminates that for the offshore investor. Now there's a question of whether they have to report taxes at home if they've invested into a Grand Cayman LP or a BVI LP. That's a question for the investor, right? Does their home country have, like in the United States, we have global reporting, right? I can make money in Zimbabwe and I still have to report it to the U.S. government. Whether the investor's home country has that or not, it's a question for the investor, and it's their responsibility to report their own income taxes. And so, obviously, we tell all investors, hey, speak to your tax advisor and do all that stuff. But we're not in the business of giving tax advice to those investors, right? So, but they are responsible for their own income, and the country of Grand Cayman or the jurisdiction does not have taxes. So that's why a lot of people choose them, right? And friendly regulations. And then from there, the income that they receive, let's say it's 10%. Well, then, if their local government has income tax on it, then that's their prerogative, right? So,
are there other jurisdictions or countries that are popular with fund managers starting an international fund
offshore
besides
stuff.
Grand Cayman?
I mean, Luxembourg is always one of those countries. There was some talk about Romania for a while, but I've never done anything in Romania. Ireland's always been in the conversation. I prefer to stay out of the EU, in Europe in general. The cost is higher for the client. It's a relatively simple structure if you really compare it to, institutional models, and it's just the fact that they're in Europe, they cost significantly more, and they're also less, I guess you'd call it, easy to work with, right? So we prefer to go to Cayman or BVI for that reason.
So this whole raising capital from international investors is mainly for funds that get to a certain size, and they're doing like 50 million, 100 million under management.
Mm-hmm.
But let's go down to some of the smaller guys. Are you seeing a lot of new small local regional lenders that are starting funds and let's say the past year or so?
Yeah. I mean, that's been the driving force, right? So what ends up happening is the local lender is going to be typically doing something that's kind of quasi-compliant, raising money to their friends and family through like a note or a trust deed investment or something like that. And they're just going to be getting sick of it. And they're going to explore the balance sheet strategy, or they're going to they're going to go shop a line of credit, and the line of credit bank will tell them, no, we want to see a debt fund, right? So that's typically how they come down the pipe. What's interesting is that what used to be, hey, I'm just going to lend in my one state, is no longer the case, right? Very, very rare. I mean, I'd say 75+% of new emerging managers already lend in a handful of states, if not more than a handful of states. And that's been really great to see. So yeah, I mean, it's no longer kind of local lenders. It's more, everyone's now a regional lender. Very rarely are there's local lenders. And that also warrants a more diverse capital strategy. It's very hard to do trust deed investments in multiple states and multiple jurisdictions and across state lines. And notes get a little messy because you can't get a line of credit, or it makes it harder to get a line of credit. So, the fund becomes a very attractive option for them. So.
And when lenders that are regional and they manage a fund, are you finding that the other states that they lend in are adjoining states, or do you find there's some fund managers that are regional, but the regions are spread across multiple parts of the country?
There are clients that are kind of like bi-coastal a little bit. They kind of look at these kind of large MSAs, and they have weird allocations of state. Very like probably 20-30% of people out there. You still see a more regional concentration, right? Most folks that we meet these days are lending kind of in the small states. You see a lot of southeastern concentration. That's where the more opportunity seems to be. Southwestern is always going to be popular for us because we're physically here in California, right? And so we see a lot of that still. It's still, very rarely you're going to run into a lender that is California, Arizona, Texas, and all of a sudden does a deal and is doing deals in mass, right? You still don't see that very often. So now, granted, the national guys are, right, of course. So.
All right. And then how about, you mentioned, lenders that try to get a line of credit, but if let's say there's a fund manager who wants to get a credit line for just to have, some additional leverage, is it getting easier these days to deal with banks, or is that still a challenge after all of what happened in the past?
It's hard. It's very relative, right? Because let's see, what is it? Strangely enough, I've been doing this long enough to be able to remember how relatively easy it was back about 5 to 6 years ago. And the qualifications were relatively straightforward. You fit the box. And the only thing to deal with is the length of the underwrite because they're a bank, right? And even the non-bank, master repurchase facilities were relatively quick and, straightforward to qualify for. That's changed dramatically since all these, economic woes we've had the past 2 years and the banking crisis we had a year ago. So for sure. It's still not where it used to be, but comparatively, there have been a lot more banks jumping into the space. So, there's probably what used to be kind of 3 or 4 is probably now 5 or 6, 7 maybe. It's small banks, local banks. The same players are still actively involved, but because qualification is so hard for the small guys, that's where the little banks really help. And then there's some new non-bank lenders doing this stuff too in 2 forms, right? The short-term kind of fund to sell, and then you have the long-term stuff, right? And so, and both are doing quite well. We're getting more of those term sheets from clients than anything else. They are obviously able to move faster because they don't have the bureaucracy a bank does, but they're still relatively selective in their criteria. So yeah, I mean, it's still not, it's nowhere near where it was 4 or 5 years ago, but it's getting better slowly. So.
And do you ever see lenders that use a bank credit line as their primary business model, and then they eventually start a fund? And if so, why would they make that switch?
So it very much depends on the sponsor, right? So there are some sponsors out there. We see a lot of this in the Midwest and in the South, where they're former bankers, and so they have access to very, very flexible lines of credit from their local and regional banks, and it's their relationship. They used to own a bank, they used to be on the board of a bank, that kind of stuff, right? The challenging issue is the PG issue, right? So, some do have PG, some don't, right? Personal guarantee. The other issue is, are they using it in a way where, how are they filling the balance, right? Because no matter what, the bank's only going to advance a certain amount, right? So how are they filling the gap? And so that's where the problems come in, and what leads them down the path of considering fund, because every bank in the country is going to say, hey, we got to tighten up leverage or tighten up policy. And so what the lender finds himself in is, and their deal flow is outpacing their capital. And so that 25% down part that they got to fund, right, they're running out of capital of their own money, right? So that's when raising capital becomes a conversation. So yeah, we have that kind of call probably, I don't know, maybe once a month, we see a lot of this also is the guys who transition from non-QM into our sector, because they're relying on their non-QM kind of repo lines, but there's limits of concentration of what they can do in this world, right? And so they come over asking for intel about a line, they go talk to a line provider in our sector, and they realize, oh, wait a minute, this is very different than what I'm used to in non-QM, and then they go ahead and they build a fund, right? So, that's another reason why a lot of clients kind of join the two together. So,
great. And before we wrap up, I wanted to get your thoughts on, or your prediction for 2025. When I ask people for predictions, we're almost at the end of February. So starting in March, I'm not going to be asking people for predictions because it seems like it's a little too late. But since it's early enough, outside of the funds and the REITs, what's your take on the market, and what do you see happening in 2025?
I think there's going to be a pretty significant uptick of institutional strategies, right? And we're already seeing it. More and more deals will be closed in the next 2 quarters on the securitization side, rated and unrated, than last year, right? That's guaranteed. I already know how many people are in line for them, right? So that's definitely happening. So you're going to see an increase in what I would call institutional qualified or qualifying kind of RTL hit the market, which is derived from an increase in what you would call institutional capital, right? That's a definite will happen. It's not a question of when it's going to happen. It's going to happen this year. But that also has a side effect, right? A lot of people don't discuss this part, right? It has a massive side effect because you have a large subset of borrowers that don't fit that box. So I think, and also to qualify for those things and to get the best deal possible on those securitizations, the originator also has to have a pretty hefty balance sheet. So I think that's going to lead to more balance sheet conversations. I think we're going to see I think we might see some interesting, I don't know about high profile, but like interesting acquisitions that might happen this year. We haven't had that in a while. I think it's going to happen this year. I think we'll see also some failures this year, notable failures, not like, this local shop shut down. I think we're going to see notable failures this year, because when you have that much institutional capital in the sector, there's going to be folks that chase and make bad decisions. It kind of reminds me of what we saw in, like, I would say 19-ish, right? Even 2021. A lot of activity, a lot of like energy, right? I don't know if DSCR is going to, fare as well as it did last year. I think the treasuries are not doing so hot right now, so it's going to be kind of a bumpy ride. But the nice part is infrastructure's been built, so now the industry is no longer kind of in a storming phase. It's now kind of stable, so that's a good sign. But I don't know if it's going to be a big driver as compared to last year, just because the way the the treasuries are acting right now. And then for, I would say, a lot more new market entries, particularly from the conventional world. That trend will remain true. I think you had a lot of that happen last year and the year before, and I think you can continue to find those folks make their way over here. There's no reason why they wouldn't. They just got to be able to figure it out. So hopefully the big shops don't, because that's going to make things look difficult for everybody. But we're definitely going to see a lot of that happen too.
With all the securitization activity that drives new capital into the space, that gives lenders the ability to fund more loans, at some point, do you think there just won't be as many loans to provide, where there's not enough deals out there, or do you think there's just an endless amount of real estate flipping activity or construction activity that could happen if there's just more capital in the space?
That's a good point. Yeah, I mean, we had this discussion on stage one time, and I think I also heard Eric Abramovich talking about this. Like, is there really an inventory issue, right? Do we actually have an inventory issue? On the flip side, I've also had the counter argument being made, like, will all this influx of institutional capital lead to what I like to say funny money times, right? Where people start chasing and you start seeing an increase in risk because there's less volume to be had, right? So, yeah, I mean, I think it's a very valid question. I don't know. It's tough to see, but usually that's kind of what happens, right? You have a sudden influx of capital, and to become competitive, to be competitive, there's going to have to be more flexible terms, which means increase in risk. So, and then if you talk to local originators, they actually comment on, like, the securitization guys are actually taking way more risk than we are. And they make that argument all the time, and they're technically right. I mean, from an LTV standpoint, they kind of do. So, yeah, they run FICO, yeah, they run credit appraisal, but the leverage ratios are significantly higher. And so, there's that argument too. So, I think that's the concern that I have. I don't know about the shortfall of deal flow. Deal flow seems to be underpacing historical years, and it's just really the lack of the ability to sell the properties, which is a product of the conventional market, right? I don't necessarily know if we have I don't know if we have a shortage of deals in our industry. I'm not that's a very data centric question. I'm not a data guy as much as I like to think I am. So
Sure. Well, it seems like this happens every once in a while, where there's a ton of capital that comes into the space, and then I see it in my business where lenders say, "Hey, we can go up to 90% of the purchase price, and then 100% of the rehab." And then when the capital pulls back, then they reduce it down to 85, 80. Do you think that just with all the securitization activity that they just loosen up on certain things, and that's where the risk is?
Yeah, I mean, the argument has been made. I tend to agree with it. That will it cause a race to the bottom? Kind of, you saw the same phenomenon happen when the secondary market first came out in our industry back in 14, 16-ish. Like, you saw suddenly an increase in risk and a decrease in rate. And so, will that be another phenomenon that occurs? I mean, it's a corollary argument that can be made, right? The question will be, whether or not the investment banks that set these deals up will allow for it. But that's where unrated deals tend to find themselves. I have clients constantly complaining about, XYZ national shop, killing them on rate or killing them on leverage or both. and they can absorb the risk, right? They're big enough to absorb the risk, so that's their logic behind it. So, yeah, I think it's possible. I think it's if let's just say if we see about maybe 1.5 to 2x volume from last year to this year in securitization, I think it's a concern that we have to address. Yeah.
And it seems like whenever there's a year like we had in 2024, where it seems like, oh, this is a record year for a ton of lenders. If the volume goes down a bit, then the sentiment is, oh, it's such a bad, the times are so tough. We're not doing as much volume, but the reality is it's still a ton of loans that they're funding. Do you think that 2024 was an anomaly, or do you think it's just hey, this is how things are going to be going? It can only go up from here.
Well, I mean, considering you compare, it's hard because our industry volumes have always gone up, generally speaking, and that's really because you have markets that haven't been really attacked in our sector and are now being attacked, right? Like Michigan, Ohio, Minnesota. These are markets that are never been paid attention to that much, but we're starting to see activity. Kansas, Nebraska, Iowa, like they're markets that are actually starting to pay attention to, right? So that adds to the national volume. So yes, they had a record year last year. A lot of folks had record years last year. But I also want them to qualify that, because how much of that was DSCR? Because it's a different calculation, right? That's the kind of questions you got to ask. What was your record? What was your actual like RTL volume compared to your RTL volume in previous record years? And you also want to ask yourself a key question: how much of that was repeat borrower, right? And that's where most lenders tend to win. And so I don't necessarily know that we're going to start seeing a downtick in volume, considering that a lot of borrowers are still on the sidelines. You still hear about it all the time, right? They'd rather go all cash or than deal with the financing aspect of things, or the deals aren't penciling, so they can't get the financing. So I think there's still a lot of desire, and there's still a lot of aging inventory. So I don't know. And then also like the natural disasters that keep happening, right, with the fires and hurricanes, and so that creates interesting demand. So it's hard to tell whether we're going to see a downtick in volume anytime soon.
And for the lenders that do a lot of DSCR volume, do any of those lenders use their fund to fund a DSCR loan and then sell it to the secondary market? Or do you find that most originators are just using a wholesale program from a much larger lender that specializes in DSCR?
Until last year, 100% of people were doing this kind of like correspondent table funding brokerage arrangement because it's just easier. And frankly, they didn't want to hold on to the paper. Starting last year, we started getting a lot of inquiries of like, I'd rather sell this stuff. Can I do that, Kevin? And I'm like, yeah, there's people there to buy it. You have to find the right buyers for it. Most of the programs in our sector are wholesale relationship arrangements, but there are people that'll buy it. So you have to find them. So, but yeah, I mean, it's started to become a conversation last year. It was very outside the norm because it was coming from sources that I didn't expect that would want to sell this stuff, like actually hold it and sell it. So, it's now a pretty common conversation where they prefer to sell it. So
is that just because they'd earn more money on the deal? If
better economics for the seller than it is for brokerage, and then there's an avenue for it. So now there's an accessible avenue for it, it seems. So,
but the risk is I mean, you kind of lose your shirt on holding these loans on your balance sheet if anything significant happens in the market, right?
Correct. That's the risk you're taking, right? So that's the beauty of the wholesale programs. This is 30-year paper. Our lenders are not usually, our clients who are kind of traditional RTL lenders, they're not built to be a long-term, paper holder. So, yeah, they really should think about that. The nice part is there seems to be a growing demand to buy it, which is good. So
nice. All right. I think that's all I had on my list. Anything else you wanted to add to that?
No, I mean, I think it's important for our industry to really, stay actively engaged in sharing information as well. So I encourage everyone to come out and go out to events, right? And one of the biggest things one of the best ways to learn is go out to events. Go to AAPL's conference, come to our conferences, Go to your local trade shows. That's very, very important. Do that, and you'll gain a lot more than you will just for sitting in your local market. So.
Yeah, and then your next event is May 1st in Las Vegas. So looking forward to that one. All of your conferences are stellar. One of my favorites to attend. So
thank you. Yeah, Ruby works real hard on that. Ruby and Sierra now work on very, very hard on that. So we switched them around this year. So we're doing Captivate in May, and we're doing Innovate in August. So we're going to Vegas in May now. So it should be a good time. Much better weather, and a much more interesting time to have a conversation about capital. So,
agreed. All right, looking forward to seeing you there.
Absolutely.
All right, thanks for your time.
Absolutely. Thank you very much for having me.
And that's a wrap for this episode. I'll put a link to Gerasi Law Firm's profile in the description, and I'll put a link to Kevin Kim's LinkedIn profile as well. Reach out to Kevin if you're a fund manager or if you're trying to start a debt fund, and I'm sure he can help you with whatever your needs are. Reach out to Gerasi Law Firm for all your legal needs related to private mortgage lending. They are experts in not only securities, but in compliance, licensing, transactions, loan docs, litigation, and more. I put a link to their profile in the description. When you reach out, please tell them that you heard about them on LenderLink's podcast, Private Lending Insights. Thank you for tuning in and listening all the way to the end.